All right, today we're cracking open the latest annual report for China Environmental Resources Group. Now, this is a company with its fingers in a lot of pies, everything from car parts to timber. And at first glance, their report looks like pretty standard stuff. But, if you dig a little deeper, you find a warning that raises a pretty serious question about the company's future.
So, what is that big question? Well, it's not one we're asking. It actually comes from the people who know the company's books better than anyone, their very own auditors.
You heard that right. The auditors have put it in black and white. They've flagged a material uncertainty, which may cast significant doubt on the group's ability to continue as a going concern. Now, in plain English, that is the accounting world's version of a giant flashing red alarm bell.
So what exactly is a going concern warning? Well, think of it like this. When you look at any company's financials, there's a basic assumption that they'll still be around next year to pay their bills and keep the lights on. This warning from the auditors is them saying, hold on a minute, we're not so sure about that basic assumption anymore. They're seeing some serious issues, like big losses, that make them question if the company can survive. It is a really big deal.
So what are these numbers that the auditors so worried? To understand that, we need to zoom out and just look at the big picture from this past year. This is where we're going to find the first big clues. And here is the headline number, a total loss of 42.9 million Hong Kong dollars for the year. I mean, that is a significant hole for any company to be in, and it immediately tells you that things are not going well.
But here's where the story gets a little strange. As bad as a $43 million loss sounds, it's actually a huge improvement. The year before, they lost over $72 million. So they've managed to slash their losses by about 40%. The real question is, how did they do that? And does this mean things are actually getting better?
Well, if you thought they cut their losses by selling more stuff, you'd be wrong. In fact, it was the complete opposite. Their total revenue, the money coming in the door, actually took a massive nosedive. It fell from almost 83 million Hong Kong dollars down to just under 61 million. That's a drop of more than 26% in just 1 year. And this is a huge piece of the puzzle. So how on earth can a company lose less money while also bringing in way less revenue? I mean, it sounds like a riddle, right? To solve that, we've got to pop the hood and see how all the different parts of their business are actually doing.
And wow, this chart right here tells you so much of the story. Just look at that. A massive 80% of all their revenue comes from just one place: motor vehicles and accessories. Everything else, property, metal recycling, it's all just a tiny slice of the pie. This means the company's entire fortune pretty much rises and falls with this one single division.
And wouldn't you know it, that's exactly where the problem is. Sales in that key motor accessories business, which is mostly selling Pirelli tires, they just plummeted, a drop of over 28%. The struggles of this one segment are pretty much the reason for the company's entire revenue problem.
So why the sudden drop? Well, the company points the finger directly at the broader economy. They're saying consumer confidence is at an all-time low. And it makes sense, right? When people are worried about their jobs and the economy, they're not rushing out to buy premium tires. They're either putting it off or they're just buying cheaper brands. It's a classic sign of a consumer slowdown.
And the pain wasn't just limited to the auto division. Their metal recycling business had an even worse year. I mean, revenue there didn't just fall, it absolutely collapsed. From nearly $10 million all the way down to just $2.8 million. That's an incredible 70% drop.
And the reason for this collapse points to a huge problem in the Chinese economy: overcapacity in the steel industry. There's just way too much steel being produced, which absolutely crushes the price of scrap metal. When prices are that low, there's just not much money to be made in recycling. So the company has intentionally pulled way back on this part of their business.
Okay, so falling revenues from their actual business operations, that's one thing. But it's not the whole story behind the company's losses. A huge chunk of that $43 million deficit didn't come from day-to-day operations, but from the simple fact that the big assets they own are now worth less money.
First up, let's look at their real estate. They had to record what's called a fair value loss of almost 16 million Hong Kong dollars. Now, this isn't cash that actually walked out the door. It's really just an accounting change. It's their accountant saying, hey, those properties you own in China and Hong Kong, they're just not worth what they were a year ago.
And then we have a more unusual one, a $5.4 million loss on what they call biological assets. Sounds pretty technical, right? Well, in this case, it means a gigantic timber plantation out in Xinjiang. And just like their buildings, the estimated market value of all that wood has gone down.
And this table from the report is fascinating. It shows just how volatile and honestly how subjective these asset values can be. So their timber is currently valued at about 173 million RMB. But look at what happens if the market price for timber changes just a little bit. A mere 10% drop in timber prices would force them to write down the value of that forest by another 17 million RMB. It just goes to show you how much of their balance sheet is tied to market forces that are completely out of their control.
So, with their main businesses struggling and their big assets losing value on paper, what does the company itself think is going to happen next? Let's take a look at their own forecast for the road ahead.
Unsurprisingly, the company's outlook is pretty gloomy. They are expecting major economic challenges pretty much everywhere they operate. They're pointing to a slowdown in the US, the ongoing property crisis and low consumer confidence in mainland China, and a sluggish market right at home in Hong Kong. It's basically a perfect storm of economic headwinds coming from all directions.
And this brings us right back to where we started, that really serious warning from the auditors. We've seen a company with falling revenue, assets that are losing value, and an economic forecast that looks pretty bleak. It all leads to one single critical question. What is the plan here? With all these business lines under pressure, where's the growth going to come from to steer this ship through such turbulent waters? That really is the $43 million question.